do for home services when private equity starts to get interested in a business is about a 10% EBITDA margin. So EBITDA, does that do you folks know that?
Fancy word for profit?
It's a fancy word for profit.
It's Movified Mondays. It's Movified Mondays, where mindset meets momentum.
Hey, it's Mark Hirschi here with Movified. It is Movified Mondays. This is the final episode of the Fireside chat held in Wooster, Ohio. And it is from the Built to Move conference. We are super excited to have Corrie Menary from the Kirkland Capital Partners. Have you ever looked at wanting to have a private equity firm assess your company? Corrie goes through exactly what you need to know when it is time to want to sell. It is a fire episode, and I can't wait to share it with you now. Roll the tape. Here we go.
Not sharing. Well, what does that mean? I don't want my business to be owned by somebody else. Inevitably, you want to be building a business that has a life that's longer than your own, okay? And so if you're doing that, there will be a transition in the future. Now, sometimes that transition could be to your kids, right? You're going to pass the business on to your family. Sometimes it could be to selling to somebody else that is in the company, that is a really up-and-comer at the time. Sometimes it's selling to another moving company, right? That's an obvious exit. And then the third scenario is you're getting an investment from somebody like ourselves or another firm that is just an investment. But all of the people in this room, if you're building a successful business, you will have to manage through a transition at some point in time. Now, the one thing that we sadly see a lot of times is that transitions are sometimes happening for reasons that weren't planned, okay? So let's go through the scenarios that could impact a transition for your business that wasn't planned. Sadly, death, disability, divorce, all of those things happen in people's lives that were not planned at the time that they happen, but have to be dealt with in terms of a business transition. Sometimes it's a disagreement, right? You're partnered with two people and something's not going well, so you guys have to find a way to resolve that disagreement, which ends up separating the business, selling the business, something like that. It could be distress, right? The business is financially challenged, and some constituents, maybe it's the bank, is saying, hey, we got to have a conversation, we got to find another home for this business. The most important way that you can be successful in terms of a future transition of your business is for that transition to be driven by a decision that you make. The who, the what, the when, the where, and the why. And so while you're working every day to build your business, you also have to be thinking in the background, what does that decision look like for me? And how am I making decisions every day along the way to make my business more valuable in the future? One of the things that I think is very interesting about the market is that if we were to rewind the clock 20 years, private equity firms were not investing in home services. Okay? It was not a sector that was getting outside investors' interest. And this has shifted significantly, I would say, in the last 5 to 10 years. We're seeing it, obviously, which you guys all know, HVAC. We're seeing it in roofing services. We're seeing it in landscaping services. And now we're seeing it trickle into other segments of home services. So I think overall, that is a net positive for everyone in the room because there is more of an investor appetite to bring capital to the table to invest in businesses like yourselves. Some of the reasons why I think home services are now on people's radar, there's a lot of macro data that they can look at to predict what is going to be the pattern of demand for this industry and what's the window of time that I'm planning to invest in it. The other piece is it's a big market, right? You think of how many households there are in America. You think about the fact that those households are going to need these services at some point in time. And then the other piece of it, which may be more specific to HVAC and some of those services more particularly, is that we've got two things going on. Number one, I think as a society, people are getting less handy and less capable of doing work on their own, right? They don't have the aptitude or desire to do the services themselves. And then also we have an aging population. So even if they would have done the services themselves, they would have hired a U-Haul truck, whatever it is, when somebody's in their 60s, 70s, 80s, and they're moving as an example. people, they're more likely to hire people on the outside. So private equity is definitely coming in to the home services industry. I would say the moving sector in particular is still very early innings. So it's not like you're seeing transactions happen every day like you are in those other sectors. But I see money shifting in this direction over time. That's just my personal opinion. So I'm here to answer questions that any of you guys have about things that you can be doing to make your businesses more valuable and more attractive for a future buyer.
Moving company owners and home service businesses. This is not another conference pitch. This is about fixing what's been holding you back in your business. If your team is busy, but your profits are flat or worse, negative, your systems are honestly broken. We're going to show you how to rebuild them. So join me, Jeremy Miner, Jason and Allie Watson, and others on January 9th and 10th in Chandler, Arizona. It's 2 days of proven frameworks, sales training, operations training, and strategy that you can take away right back into your business. You'll walk away with clarity, confidence that moves your business forward. So click below and get in the room.
Before we ever started using a moving CRM, someone asked me, could you 10x what you're doing right now with the current systems and processes you have in place? And I said no. And so he was like, well, then you need to just pull the trigger on the software. And then I saw Smart Moving and it was game over.
Austin joined thousands of moving owners on Smart Moving in 2021. Since then, he's more than doubled his business.
And I always compare Smart Moving to Apple products. It's just so simple, so easy to use. And that's really what's allowed my team to scale and now have 2 branches. And last year we scaled Central Coast Moving over 50% growth.
If you're ready to turn your moving company into a machine that drives profit, not chaos, try Smart Moving.
Hey, it's Mark with Movified, and I'm here to talk about Canada Home Listings. They are the only direct mailer service built specifically for household good movers in Canada. That's right, my hometown. They help moving companies reach homeowners the moment they list their home with proven mail campaigns that drive results. And for the Movified listeners, they're offering exclusive promotions you won't find anywhere else. So go check them out today. Go online, go do your thing, and go find them. Canada Home Listings right now. Go. And then keep watching the show.
Happy to open up the floor and switch to questions. Yes?
Yeah, like what specific piece, like what are like the top 3 things that stand out to you when you want to invest into a company like ours?
Yep, okay. So the obvious 2 things that any buyer of any business is going to look at is revenue growth and what earnings margin are you getting on the business. So when we think about revenue growth, you're going to be measured against how is the market growing and how are you performing versus the market. So, you know, if you go back a couple of years, we had a gangbuster moving market, right? The market was hot. Well, you want to be measuring yourself, did I perform better than that? Or was I a little bit behind that measurement stick? Obviously, specific to the geography that you're selling in. You know, we might have a landscape where housing sales are going down, right? Maybe they're down 4% in your market. Well, if you're staying flat year over year, you guys are actually growing your market share because the only way you can stay flat with that backdrop is by taking share away from other players. So the growth is going to be measured over a few year period of time, but overall they're going to be looking at how are the trends for this business versus the overall marketplace. So with the earnings question, you know, I sort of view for home services when private equity starts to get interested in a business is about a 10% EBITDA margin. So EBITDA, does that, do you folks know that?
Fancy word for profit?
It's a fancy word for profit. So it's profit before you pay your taxes and before you pay your bank interest. That's a simple definition. And so everybody's going to have their own threshold of where they want to see that percentage to be, but at a minimum, you should be thinking about a 10% as the opening conversation to start getting some outside investment.
What's the minimum total EBITDA you see? Like, for example, like the minimum before private equity gets interested might be 2 million EBITDA,
Yeah.
3 million EBITDA, 4 million EBITDA.
Yeah, so the private equity industry has players of all sizes, okay? So our firm invests in smaller businesses, so we'll start as small as $1 million. And it's not for every industry, but that's our floor.
Home service,
Right.
home service.
Other folks might have 5 as their minimum. So it's really dependent on how much capital they're trying to put to work in any specific business. So it'll be very situational as to what their minimum is. So beyond, do you have a question?
Yeah. Have you seen your firm or other firms invest in companies and look at it in terms of future earnings, if there's like a roll-up strategy in place or something like that?
Yes. So I'll give you an example, not home services specific, but I think it'll guide you to what you're talking about.
Yeah.
So we invested in a business a year ago that was a manufacturing business. Now their margins were a little lower than we expect to see for the type of business that it was. But they had built out the whole management team. Okay, they had every block filled in that we would want to see in the business. So we said, hey, if we buy this business, yeah, on the front end, the earnings are a little light, but when we acquire the next business, we've already got the team, right? And so that was a situation where we could see that the owner was building for growth, and we were willing to sort of sacrifice a little bit on the earnings side because we knew it would be a good platform to acquire more businesses. But you got to remember, private equity firms and other buyers are looking at a lot of businesses very quickly and making decisions on a day-to-day basis, yes, no. So, they may quickly pass because they don't have the time to invest to say, okay, is this one worth more attention? Is this one worth a deeper dive?
Hey everyone, Matty Mailer's here, the guy who pioneered handwritten letters for the moving industry. Why? Because my competition at my moving company was using the same stock postcards as me, and my mailing company didn't care. So I created a better way. Here's some mind-blowing results in July. Miracle Movers Utah closed $93,000 using our handwritten letter strategy. With our campaigns, you can forget about the guessing games. You get a trackable phone number, daily photo proof, an incredible design team, and I'm also included. All letters stop at me for approval before they ever leave our facility. Right now, Movified listeners get 1,000 golden tickets stuffed in our genuine handwritten letters completely free. Plus, I'm going to throw in bulk realtor data for up to 5 counties. What are you waiting for? Moving Letters AI. Stop competing, start dominating.
If you're considering Snowball, just do it.
Snowball creates done-for-you referral programs for moving companies so you can turn happy customers into new revenue without lifting a finger. And the results speak for themselves.
In less than a year, we've collected over 2,000 referrals.
We generated over $200,000 of revenue that cost about $5,000 to do it.
I believe we had 4 or 5 the very first day.
The companies winning with Snowball are the ones that already care about their customers. We just help turn that into new business through human outreach and customer nurturing.
Snowball is part of the arsenal of tools that I recommend to my clients because it works.
What are some ways that you can increase your multiple with non-specific or EBITDA? So like having different marketing channels and all that good stuff. Like what are y'all looking for? What size of the EBITDA?
Yeah, so there's a couple things that I would point you to. So it's assumed to be table stakes that everyone in this room is capable of performing a move. Because if you weren't capable of performing a move, you wouldn't be around any longer, right? So I think of the bells and whistles on the outside of that as being the differentiator for why one business would get a little bit higher multiple than a peer that's the same size. So things like lead generation, lead conversion. Are you able to pull in more business than someone else having the same level of activity? Maybe it's on the operations side of the business, where you're managing your routes more efficiently, making sure you have fewer downtime days where folks aren't working actively on something that's revenue generating. And then the last piece, which I know other folks have talked about during the sessions, is retention, people side, right? If you do a better job of selecting your staff on the front end, so you get 5 guys to show up for a job interview or apply for the job, and you're better at picking which one you hire, and then in addition to that, better at retaining them, so you're not churning that staff as often. Those are examples of things that could get somebody's attention. So just being mindful of that.
So just to kind of piggyback on that, do you ever weight a deal more favorably just because of the owner or the founder themselves? You just feel that that person is just an absolute rock star.
Undoubtedly.
Even if it's a little bit, maybe things look a little lackluster on the outside.
For us, the
Yeah.
people side is hugely important.
I want to piggyback off that. So like, I know not all private equity companies are pretty equal. And you get some out there that they're just going to dump capital on there and they're expecting to do it all. But like in home service, I say for a lot of us, like I'll use myself for example. Like say we're a $10 million company. We have a 15 to 20 EBITDA, like percentage or whatever. So we're doing 1.5 to $2 million in profit a year. But like for example, me like. I know what that looks like. I might not know what $15-20 million company looks like. So for me, I would like just the PE company that offers me the best deal, like I need the best fit. Really, what I need is a PE company that can also be a strong operational partner.
Yes.
So how can we as owners really kind of what's some things that we as owners are looking to go down that route that we can do in order to make sure that we pick or have the best successful chance of picking the best operational PE firm to work with, because there's a lot of horror stories out there.
Yeah, absolutely.
Yeah.
So a couple ideas of how to address that. So first of all, I would be asking how often they're investing in businesses of your size, okay? So if there is a big mismatch where they're used to much bigger companies and your business is smaller, or the inverse, it may make me question whether they have the right tools to help my business. Okay, that would be a question.
Yeah, can you see gaps that I'm missing? Can you really help turn on the hiring recruiting funnel and bring me the talent that I probably could never acquire on my own? I think beyond just the capital you're going to infuse through rapid growth, because we still need badass operators
people
to be able to handle that rapid scale. And I kind of know how you guys approach things, but those are always going to go through my mind because I want to go down that path eventually. And if I'm just being humble about it, like there's some intimidating things about that, because like I said before, I know what this level looks like.
Yes.
This level, it's the wild, wild west to me. You don't know what you don't know, so you do. So someone like me would rely on people like you to help guide me along that way.
Yeah. So I would continue, if you were meeting with potential investors in your business, ask a lot of questions, right? The private equity firm is never going to be shy about asking you questions, especially as the conversations progress. But you're in the driver's seat if you feel like this is a good fit. So ask questions. And in addition to that, ask for references, right? It's even better if you can backdoor a reference. So saying like, okay, I know that they gave me 3 names of companies to call. Well, they also bought this other company that I've heard of before. Maybe someone in my network can help me connect to them. But references can go a long way to figure out what's the day-to-day like with your new partner. And I do think, we talked about this downstairs during the first session, you can't have it all of the time when you're selling your business. So there's situations where you're gonna have to pick between 2 groups that are interested in your company. One group might have the highest value, but you're uncomfortable about how they're gonna treat your people, what your role looks like in the new organization, what the name of the business is going to be. I mean, there's 100 different things that can happen. And your gut, I think, is important in saying like, okay, am I willing to trade a little bit of purchase price for a better feeling about who I'm going to partner with over the next 5 years?
But both individuals that I know personally have done PE, who they went with was not the best offer financially. But it was like the best fit for overall operationally, etc. Like where they can fill in the gaps that maybe the company lacks at the time.
Yes. And a lot of times if a private equity firm is investing in your business, they're going to be looking for you to retain ownership, okay? So you're not just walking away in the sunset. So the value of that retained investment is highly dependent on the person you're partnering with, right? So you might be actually better off creating value today and having confidence and a belief in the person you're partnering with, and then see that monetize itself all the time.
Being found on the second page of Google, is literally like having a billboard in the middle of the desert. Your mama ain't gonna see it. No one's gonna see it. You're on the second page of Google. No one's gonna call. No one's gonna book. Here is the deal. If your business is not ranking on the top of Google, that means your competitors are going to be stealing your customers every single day. So at Rotate Digital, we don't play any guessing games. We use data-driven SEO strategies to make sure Google finds you first so that these Google searches turn into your customers, not your competitors' customers. How do we do it? We do it through AI-driven keyword optimization, exclusive blog networks, backlinking strategies, and honestly, the secret stuff, the proprietary lead attribution software. So what do you get as a result? You get not only good marketing, but now you get clarity into what is bringing you more revenue. So if that's something you want to do, you want to make sure your leads find you and not your competition, go ahead and go to rotatedigital.com, schedule a call, and we'll help you take your business to the top of Google.
Hi, I'm Mark Hirschi with Salmon's Moving and Storage. Today, I want to talk about Tighten Up Training. Why? Because this is Netflix grade quality training. It's not those old videos and VHSs that you got hiding in your office somewhere. It's online, it's easy to use, they're short videos, but they get to the point. My new employees, these guys run through these training programs, there's tests at the end, and they're coming out going, oh, I'm ready to rock. So if you haven't checked out Tighten Up Training yet, get a demo done. Get on board. Guess what else is there? Online portals for my sales staff. Can you believe it? These guys can learn how to overcome objections and book more leads today. So what are you waiting for? Go check out Tighten Up Training today.
And I think one of the things you have to be really honest with yourself about too, which is important, is what do you want your role to be afterwards? Are you going to be okay if you're not the lead guy anymore? A lot of people, the ego and sort of the type A personality, it can be very hard to not have the same role that you had before you exited. So you just have to really think through, what does that look like for me? How does it work for my lifestyle? Is this what I want? And then obviously within the constraints of how do I transition this business in a way that the next owner has a good business to work with. Like you can't walk out the door.
Do you see circumstances to where like the business owner may take a little bit of a sacrifice on the front end to capitalize on a bigger X on the back end? Because that's the way my mind works. Like, to me, like I'm looking at this as like the long-term journey. Mm-hmm. Like what happens in the initial part of the deal? What I really want is what happens at the after the next roll up, after the next 3 to 5 years after we work in this deal.
There have been many, many people that have made more money off the second deal than the first deal, with a smaller ownership percentage, relatively speaking, but it's been transformative.
Yeah, have a smaller slice of the watermelon rather than an entire slice, but then have an entire slice of the grape.
That's exactly right. And sometimes too, just personally, the peace of mind of knowing I have some money squirreled away, like brings a lot of like energy and like rest. It's a really good reset for people. So we've seen folks that's been more valuable for them than what they got out of the first one. So it's interesting how that can work. So here's the question. Okay.
I got a quick question. Yeah. How often do you see owners from any industry really come onto a private equity deal, exit that, and then have an appetite and maybe have the education to continue to help others in that area and continue to profit off of that? Good question.
Like almost like bring people to them?
Well, it's like kind of like once you learn I went through it with my companies, now I know the process, I understand, probably have some connections or whatever. Do you see them going and finding other opportunities, other companies, and saying, hey, I know how to do this, I can help you, for a piece?
We have seen that. So a private equity firm is going to want to see you locked up under a non-compete for a fair number of years.
At the end of when they're exiting.
Would it be in that geographic area?
It's usually at least 2 years, right?
Oh no, it's longer than that.
Okay.
Because you got to think about their hold period, right? It's going to take them 5 years to monetize the investment. They're going to want that covered. There's a difference between your non-compete as an owner and your non-compete as just a staff member, right?
Okay.
As an owner, since you're getting significant compensation for the deal, they're gonna be looking for a longer tail.
So it's 5 years after the end of it, the second roll-up?
The second roll-up.
Or it's with the initial first deal?
The first deal. I'm talking about the first deal.
Okay.
But it all depends on when the second roll-up happens.
So for example, you send the dotted line, the deal's done, and then you're going on this path for the next 3 to 5 years for the second roll-up.
Yes.
And it happens 3 years instead of 5, you have to wait 2 more years after the non-compete ends.
Yeah, I mean, the simple answer is when we buy a business, I'll just use what we do. When we buy a business, we're thinking about our hold, okay? So we're trying to get comfortably through our hold period, plus a year of cushion, because you never know what's gonna happen, so that we feel good about this person not going to start up the same business in our backyard, okay? The next buyer's gonna have the same concern, right? And so it really just depends at that point in time. If you're a marquee member of that management team that's being presented to the next buyer, are they going to ask you for another non-compete? And is it lucrative enough for you to say yes or no to, right? I mean, that's a choice you make. But that can impact value. I mean, if we were selling a business and an important person said, no, I'm not gonna promise not to compete with the person giving us an attractive multiple, that person might say, I don't buy the business the same time. So it all works together. Yeah, go ahead.
When you invest, when your firm invests in companies, do you typically like to see the founder be in the CEO role or take more of a board seat and appoint a CEO?
Okay, so this is our firm, and other private equity firms have the exact opposite playbook, so it does differ. We like the CEO to stay with the business and continue to run it. Now, we're mindful if somebody's of retirement age and they're looking to really slow down, then we'll shift them to a board seat only, but we have to be cognizant of our confidence in hiring someone to replace them. So it does factor into that conversation. Yeah.
Have you ever bought a company that was private and turned it public?
You know, our firm's been around for 50 years. Public exits are very unusual nowadays because the whole Sarbanes-Oxley, it's jargon, whatever, blah, 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 has made the cost of creating a public company and maintaining a public company to be so exorbitant that it would be highly, highly unlikely for many, many generations for a business to be exited through a public company. The one exception, which is around the corner here, Leaf Filter, which is a very big home services business, their next transactions probably will be as a public company. But I think they're through 3 private equity firms.
Yeah.
So, I mean, you're probably gonna have a sort of a journey to be on the private equity train for a few iterations until that would be a likely outcome. Any other questions you guys have?
I can talk about this all day.
Yeah.
I love this.
How do all of these, the economics of work? Like, let's say the business is generating 3 companies, they come together, you roll them up, and together they generate $100. Is that entity broken up in proportion with the revenues and then the fair value of the company that joined in together? And then does that happen before they approach a private equity firm as a whole, or is that the strategy of a private equity firm where they'll find a platform and then add more onto it, and that's where the value creation happens?
So, in my opinion, the best way for a roll-up like that to happen, where you're sort of rolling up before us private equity firms involved, if I hear you right, okay. I recommend putting the businesses under a holding company, okay? And then you're gonna make decisions about, as I bring a business under the holding company umbrella, what percentage of the equity is that business getting? Now, I'm keeping this very simple, right, to keep it conversational, but you can't just base it off of what percent of earnings one business has versus the other. Because one business might be saddled with more of the leadership team, right? They might have more infrastructure that's guiding the whole pool of businesses. So it's a little bit, in my opinion, unfair to try to break it up like that after the fact. It's better to go into it with a negotiation about, okay, we agree your business is worth a third of the pie. My business is worth a quarter of the pie, and the other person's business is worth the balance of the pie. So there's some more decision making that needs to be made in that kind of a scenario. And it's very tricky when you don't have the stock owned by the same people to try to find a future home for the business when there's 3 different companies with different ownership.
So in that scenario, then, in that scenario where it's say it's like that, and then P's going to come and do a deal with that holding company, you're not going to need all those owners.
It depends on what they're doing, right?
Yeah.
I mean, you're
Or
not.
for example, like we're like, because you guys are going to be the majority shareholder. That's a no-brainer.
That's a big
do you dilute everybody equally, or for example, there might be some of this one not completely. How do you kind of approach it? How do you dilute?
Yeah. So
who are you buying?
So we would be buying into the holding company.
Yeah.
And we would say we want to own 55% of the holding company, right?
Yeah.
And so then it would be a decision of, do we want the other shareholders to roll over? The term is called pro rata, which means proportionately, right? Where they have to be reinvested for the same percentage of the business that they were before, relatively speaking. Other times, we would say, hey, we don't need you to be pro rata. You can go right off into the sunset, right? You can cash out entirely if your partners are comfortable with it. But I really want you to have a big percentage of the pie. So it's not always a decision of expecting the same out of each participant, okay? It's dependent on the future of the business and who do we think is most important for us to have, we call it skin in the game, right, in the future. Now, the other piece that we haven't talked about is incentive equity. So if we're buying a business, and every private equity firm does this, they might do it a little differently, but we're going to say 10% of the ownership of the business may have nothing to do with what you contributed on the front end. It's like a pool. And if we've got somebody over here who is a rock star with some element of running the business, even if that person came to the table with less ownership on the front end, we might give him a piece of that pool to give him a bigger opportunity with our So that's more of just a
Because you said valuable operation.
correct,
Yeah.
as an example. Yeah.